Tobley's painting a picture for the stock market to go vertical. Check this out.
In our view, the most hated V-shaped rally because at Fundstrat, we survey people, we ask them how they're positioned, what they think of multiples. This is not that we get cautious sentiment and skepticism. That's not what you expect at the top. And that's healthy. If people are skeptical at the top, that means there's still plenty of room for stocks to go up. And we can see it numerically. I like this survey. This is the AAII bulls less bears. It's currently negative 10.7. That means there's more bearish people than bullish people. And in fact, for the last 5 weeks, as the market's made all-time highs, the net bulls is bearish. Do you see it? Minus 11. We've had 5 weeks while the market's made all-time highs and everyone's skeptical. In fact, this is from Tireless Ken, you looked at all the times the market had a 25% or more rally, and I put a red dot. Usually sentiment's quite bullish by the time you had a 30% rally. We've had a 34% rally, and yet the average sentiment is still negative. That tells me, first of all, that most people went to cash in April. They didn't think we'd recover, and I don't blame you because I remembered at the April lows, we heard a lot of people tell us, Tom, there's no way we can recover because the Fed's not going to cut rates or expand the balance sheet, so you don't have any liquidity coming. Our argument was that waterfall declines always see reciprocal recoveries. Okay, but I believe the reason people are bearish is because of political affiliation. So please do not judge me. I'm registered independent, but I want to point out some facts. I am a registered independent, and I didn't vote for either candidate in this last election. But if you look at the general population, the U.S. is 50-50 roughly between Democratic affiliated and Republican. Okay, so it should be half. But if you look at the University of Michigan survey respondents, and they published the affiliation, 60% of the people that respond to the UMich survey are Democrats. So when you see UMich inflation and confidence, just remember it's skewed because more people who respond are Democrats. The media, we know political affiliation is 89% Democratic. And we know that if you look at contributions by Federal Reserve employees, 92% donated to the Democratic Party. Okay, so as we run that down again, half the United States is Democratic, half is Republican. But media and the Federal Reserve skew Democratic. Well, look at the equity market. 57% of employees in the stock business are Democratic, 67% of hedge funds, and 69% of venture capital. Okay. So the equity world or the risk-taking world leans Democratic, which is the opposite of who's in the White House today. Whereas the bond market, 83% of those who work at savings and loans are Republican. Mortgage bankers, 64%, and commercial banks, 60%. So the bond market leans Republican. That might explain something to me because if you ask me in 2025, why did we not get bearish? It's because the high yield market barely reacted to the tariff headlines. Spreads didn't blow out. So we figured, well, if the bond market says the economy's fine, stocks should recover. So I think the reason why you might be bearish or your friends might be bearish is that the stock market is primarily Democratic and they think Trump is crazy, whereas the bond market leans Republican and think everything's fine. I believe this is the reason it's the most hated V-shaped rally. I just want to show you the survey. I mean, look at the UMich survey. The UMich survey, if you ask about inflation, Democrats respondents say inflation's 6%. 2 months ago, they said it was 9%. Republicans say it's 1%. So you can see there's a huge political divide.
Wall Street is having an identity crisis. The stock market keeps hitting all-time highs, but the people managing the money are convinced it's all about to fall apart. They're not necessarily looking at earnings, Fed policy, or economic data to reach that conclusion. Tom Lee's making an argument that they're looking at who's sitting in the White House and letting their political views override their professional judgment. The people managing stock portfolios are making investment decisions through a political filter rather than economic analysis, creating a mispricing where equities don't reflect the stability that the bond market is signaling. The argument Tom is making here and what he's identifying is cognitive capture. When your political identity becomes so central to your worldview that it distorts professional judgment. Equity investors aren't analyzing Trump's actual economic policies and their effects. They're reacting emotionally to a president they oppose, then reverse engineering justifications for bearishness. There's an argument to be had, which is if they genuinely believe Trump's policies would crater the economy, corporate bonds would be selling off hard as default risk increased. Instead, spreads are tight and bond investors are saying that they're happy to lend money to corporations. Equity investors are ignoring the signal because it contradicts their political prowess. They want Trump to fail, so they're positioning portfolios for failure even when the credit makers are screaming that failure isn't coming. But if you strip away the political emotion and just look at the actual data and what we see Tom Lee saying in almost every single interview he's in, not financial advice, but there's a bull case here which could be too big to ignore. Tom Lee sees a continuing bull market because there's so many historical patterns, fundamental indicators, and structural shifts pointing to an environment where markets grind higher even when everyone expects them to crash. The current bull market is 3 years old, and historically every bull market since 1957 that's lasted at least 3 years has extended further with an average duration of 5 years and gains of over 170%. S&P 500 earnings are growing, the Fed has shifted from hiking to cutting rates, AI is driving a tech boom, and companies like Nvidia and Microsoft are seeing massive profits. What Tom's really saying is that bull markets don't die of old age, they die of recession or extreme valuation. Again, none of this is financial advice, but neither of those conditions seem to exist right now, which means the path of least resistance is still up, despite how uncomfortable that makes bearish investors feel. Earnings growth is the fundamental engine that justifies higher prices. You can argue about multiples being stretched, but when companies are actually growing profits at double-digit rates, valuation naturally expands. The overvalued argument falls apart when you're comparing static prices to growing earnings. The multiples compress naturally as profits catch up. The Fed pivot is also huge because it removes the headwind that killed the 2022 market. When rates are rising, every stock competes against higher bond yields. When rates are falling, stocks become relatively more attractive and borrowing costs decline, boosting corporate profitability. This isn't speculation about what might happen, the cuts are already happening. Then we come to AI. AI creating a second wind is a key insight most skeptics miss. They think this is a late cycle exhaustion, but actually we're in the early innings of a new technological wave. The internet boom of 1990s ran for years because it was fundamentally expanding what companies could do. AI is doing the same thing now. Its productivity gains showing up in earnings. The broadening participation point addresses this. When a rally starts narrow and then expands to include more sectors and names, that's typically healthy confirmation that the move is healthy. Narrow rallies that stay narrow tend to fail. Rallies that broaden tend to continue because more sectors participating means more sources of earnings growth. Tom's not bullish because he's optimistic by nature. He's bullish because when you line up the checklist of what ends bull markets, recessions, extreme valuations, Fed tightening, collapsing earnings, none of those boxes are checked. One of our clients started with 0 audience. Now they're doing $100,000 months thanks to YouTube. And they're not alone. We've helped 3 businesses hit that level just by growing them a YouTube channel. Want to see how this could work for your business? Book a call with me below.